The Twitter I.P.O. Investor Beware. NYTimes.com. Homepage. Today's paper video most popular. Edition. US/Global. Search all NYTimes.com. The opinion pages. World US. NY/region business technology science health sports opinion editorials columnist contributors letters the public editor global opinion arts style travel jobs real estate autos September 13, 2013, 5:20 p.m. The Twitter I.P.O. Investor Beware City RIDCH. Dado Rubik/Reuters. The excitement around Twitter's impending IPO is misplaced. That's not a prediction about the company's prospects. Twitter's backers and bankers are all likely to become richer in the IPO, otherwise they wouldn't be doing an IPO. For all I know, the company's new public investors will also make money on the stock. The operative phrase is "for all I know." Neither I, nor any else except Twitter insiders, knows anything concrete about the company that would enable analysis of its condition and prospects. There is no official public information available about its finances, its capitalization, its operations or risk factors. It has, however, generated a lot of excitement. And that is a problem. The Times deal Professor Stephen M. Davidoff explained in an article published last night that Twitter is able to fly below the radar because of the law, passed in 2012, called the Jumpstart Our Business Start UPS, or Jobs Act. The law vastly delayed and reduced federal disclosure and regulatory requirements during and after the IPO of so-called emerging growth companies, a label that sounds pretty narrow but actually encompasses all but the nation's biggest companies, including Twitter. The immediate effect of the law is to put the interest of the company, its backers, its executives, its bankers, ahead of the interests of investors. A company that wants to go public doesn't want investors to dissect its flaws or weaknesses, whereas investors benefit from timely and detailed disclosure. The law used to side with investors, but under Jobs, that's no longer the case. That's not the only problem with Jobs. By allowing a company to whip up excitement while keeping solid information under wraps, the law invites frenzies and frauds, the very market maladies that disclosure and regulation are supposed to mitigate. True, Jobs has required an emerging growth company to give out financial information before it begins actively marketing stock to investors, but by then buzz and judgment may have already blurred. Perhaps worst of all, the riskier and less transparent IPO market is bad for the market as a whole. Investors who have nothing to do with I.P.O.S. per Southeast, can nevertheless be harmed by slumps and volatility emanating from offerings that fall short of expectations. The extent to which the Jobs Act allows a company to operate in the dark is as astounding as it is depressing. Under the law, the IPO registration statement for an emerging growth company can be filed without public disclosure and reviewed confidentially by the Securities and Exchange Commission. In other words, after decades of requiring transparency, Congress has decided that it's better for companies to work out any problems with the regulator outside of public view. But as Mr. Davidoff pointed out, investors have benefited greatly from a public SEC process that has raised prescient concerns about companies planning IPOs. That public process is now a thing of the past. In the Times report on Twitter's IPO announcement, the reporters noted that Twitter has already used the confidentiality afforded by the Act to tweak numbers and estimates and consult with the S.E.C. which could be a good thing, or not. The article also quoted a securities analyst who said that the private market currently values Twitter's share value between $20 and $30, adding not that investors have any information, but that's what they are willing to pay. In reporting on Twitter revenue estimates, the article cautioned, these numbers could not be independently verified. When the Twitter data is out, who knows what we'll learn? What we do know is that, in markets, transparency is better than secrecy, disclosure is better than withholding, timeliness is better than delay, and trust is better with verification. Unfortunately, the bipartisan congressional majorities that passed the Jobs Act, with the support of the Obama administration, think differently. Featured posts, initial public offerings, Twitter related posts. From Taking Note, Twitter surveillance resistance. Previous post f.b.i.s forced vacation. Search this blog. Search. Previous post f.b.i.s forced vacation. Follow this blog. RSS.